Um, Without further ado, let's go ahead and get started. Again, thank you and welcome to Benzer Capital, where we are interested in preserving wealth for generations. We do that through estate planning, investments, as well as tax planning. And this particular law is a major change in the landscape as we move forward. And so it is important that we discuss some of the major changes that are occurring within the law, and there are opportunities in here for us to advise our clients and those that are interested in really making a difference, both in a short term, things that they can do in 2017, as well as longer term, 2018 and onwards. So discussion points for today will give you a little bit of an introduction and disclaimers, some major areas of changes in tax laws that we'll highlight. We will look at the law specifically to the changes that are impacting the individuals, and then also to businesses. And then there are other items within the tax laws that impact the 1031 exchanges, 529 plans in the state, and we'll discuss that. And we'll summarize our high-level recommendations from that point forward. So as an introduction, as I mentioned, myself, I'm Salim Naftani. I am the principal and founder of Benzer Capital, and I am a CFP. Along with me is Mitchell Sosa, our CPA, who also hold a CFA, a Chartered Financial Accountant, Chartered Financial Analyst credential, as well as Crystal, who is our resident tax accountant. And the format of this particular conversation will be more on a question and answer basis, and we will have each of us, Mitchell and Crystal and myself, go over different parts of the tax law with you. As always, each individual family and business's tax situation is different. And again, we, on this particular call, do not intend to give any specific tax advice for anyone. This is more a general summary of tax changes as they are. And again, this is not a detailed analysis, which means that we will not be covering everything that is incorporated in the tax law. This is supposed to be a high-level discussion of things that we feel would be the most impactful to our clients and those that are on the call, that can be interesting to them. Also understand the Internal Revenue Service, IRS, is reviewing this particular tax law as it has just been enacted. There will be a lot of rulemaking that will happen. There will be a lot of changes or clarifications that will be offered at a later date. And so a lot of things that we say here on this call will further be clarified as we go forward. We've already seen one of those happen just as recently as yesterday, where the IRS clarified some rules around real estate tax prepayments. This particular conversation will deal mostly with the federal income tax, so we will not address too much of the state and local income tax. The only item that we'll address on the state and local income tax will be based on that impacts your federal taxes. And again, as mentioned before, this discussion is for information purposes only and does not entail or should not be construed as legal or tax advice by any participants. So Crystal, I'm sorry, before we jump to Crystal, just to highlight the major changes, the first big change is a personal tax rate changes. These tax rates have overall come down, and we'll see what the specifics of that is. The biggest part of the tax law change actually impacted the corporations, the C corporations to be in particular. There are lots of planning issues that we can look at from a C Corp standpoint. The tax law also impacted what's known as pass-through entities. These are most common entities used by small business owners, the S corporations, the LLCs, and the partnerships. Along with that, there were some impact to the more popular real estate transactions that happened with 1031, 529 plans. as well as estate taxes that were changed within this tax law. One factor to highlight is that the corporate tax cut within the law is permanent. However, personal tax cut expires starting in 2022, and that also presents an interesting planning opportunity and challenge, if you would. All right. Crystal, why don't you walk us through the changes, if you would, for the personal or the individual and family, starting with the tax bracket changes.
Sure, no problem. So as some of us might know, the 2017 tax rules that will apply are what were originally the practice laws, which are the brackets or percentages on the left side of this chart. That is what will be applied for 2017 as far as taxes go. However, starting January 2018 onward, these tax brackets have now been summarized to the ones on the right. So each of these will be explained just a little more in the next slide. This is just to give you a general overview as to how these percentages changed and the groupings that will apply to either single or people filing married jointly.
Crystal, does that mean that pretty much almost everyone will see a change in their taxes going forward, 2018 onwards?
Yes, everyone will see a change, specifically when they receive their paycheck, that these tax brackets have lowered everybody on the tier, since the tax brackets are tiered. As you see, it's starting from 10% going all the way to 37%, which you will see your specific tax bracket on the next slide, which specifies just a little more on how you're filing and how your salary sits on this specific tax bracket.
So this slide is a little bit busy, but it does kind of give you, again, a summary of what each individual types of families will probably see their tax brackets be. Crystal, was there also changes in the taxable income level within this tax law? So, for example, in 2017, if somebody had $500,000 in income, would they have been in a higher tax bracket? Did that change at all?
Yes, it did. It went from 39.5% to the 37% effective rate.
All right, Mitchell, any comments on your side on individual tax bracket changes?
Just generally restating what you...
Mitchell, we can't hear you. Perhaps you need to adjust your volume there real quickly. All right, we'll come back to Mitchell. Let's take a look at AGI and standard deductions, Crystal.
All right. So as you can see, for the benefit of understanding this tax law change a little more in depth, is to understand what is happening in 2017, since that is the filing year we will be coming up very soon, and what will happen for 2018's tax year, which we have to start preparing for either starting as of right now or in some cases in January, February, when the details come out on certain specified laws. So starting off, the first major change that impacts everyone is the standard versus itemized file deductions. So the standard deduction, this is the deduction that let's just give you an example of a married couple. The husband and wife each get $6,500. So essentially you get $13,000 as a joint filer as a standard deduction. That's not including what is for 2017, the personal exemption, which is $4,150 for each person living in the household that is a qualified dependent. However, this is being changed in 2018 to where the removal of the $4,150 exemption is no longer there. Later on, we'll specify what is in place for that removal. That'll be explained in just a little bit. However, this standard deduction has now been increased to $12,000 for a single filer, and joint filers have now been brought up to $24,000 as a standard deduction.
So, Crystal, in other words, is it better to understand that having more children is no longer beneficial? Is that what you're saying?
There comes a point to where it's, for simple terms, if you have 1 till about 3 children, you might not feel this impact so much. However, if you have more than 4 children, this is where you will see this not become beneficial towards you.
Okay. And another way of looking at this is to think about those deductions, those standard deductions. The idea here is to just increase the standard deductions so that a lot of people can just take those standard deductions and not feel the exemptions or not miss the exemptions. Along with that, also, does this not look at the itemized deductions? If somebody is itemizing their individual tax deductible items, does it make it more difficult for them to then take those itemized deductions? Mitchell?
Well, Salim, can you hear me?
Yeah, go ahead.
I wanted to just jump in. So it's estimated, I think, right now that over 90% of people that previously itemized due to these rule changes will no longer be beneficial to. And I know later on in the presentation we'll be getting to some of the changes in the itemized deductions categories, but for the most part, this is one of the measures that was meant to simplify, wherein granting a higher standard deduction would alleviate some of the, complexity of some tax preparers to itemize different things. So it's estimated right now that a lot of these people that itemize, it might get reduced at least probably about 90% in future years if everything here stays the same.
So shall we take a look at some high-level itemized deduction comparisons, if you would? Mitchell, you want to start?
Yeah, there's several things that are similar, but a lot of things that are now capped or basically would, might affect a lot of people. So, excuse me. So one of the first issue is medical expenses. Currently, you have to have medical expenses above 10% of your AGI to qualify under the current tax regime. But going forward, the floor is actually reduced to 7.5%. So if you still have, and that's only actually for the next 2 years, but if you have some significant medical expenditures over the next few years, you should still possibly get some type of benefit from itemizing it from a significant surgery or medical complication you might have. But aside from that, I mean, due to the higher standard deduction, normal things just that might have previously qualified you, like prescriptions and doctor visits that might have just barely met the threshold before, will probably not have any significant impact going forward. For charitable contributions, the ability to itemize that is still there, and as you can see, the limits slightly changed from 50% to 60% of your AGI. Few people really run into this issue as far as the amount that can be contributed and still be deductible. However, also due to the change in the standard deduction, I know a lot of charitable organizations were protesting the tax bill initially because they believe this might lead to a reduction in charitable giving, just simply due to somebody might have made a contribution that let them itemize before, and now that might no longer be the case. For your state and local income, state and local taxes, and for Texas, that does include sales tax, along with any other states like Alaska that don't have state income taxes. But previously, there was no limitation on what could be itemized. However, going forward under the new tax plan, that's capped at $10,000 for a joint couple or 5,000 for an individual that can be itemized. So anything, if you pay property taxes, state income taxes, or sales taxes, and it's in excess of $10,000, you're not going to be allowed to claim more than 10,000. One of the interesting changes that happened, and actually it's kind of relevant due to the recent flooding that happened in Houston, was that previously you could itemize casualty and theft losses, and this didn't have to be in a declared disaster area, but going forward, actually you're only going to be able to itemize you're only going to be able to itemize if you suffer a loss that is not covered by insurance in an officially declared disaster area. So the hurricane would have counted, or wildfires or things like that. But if you just have a random incident at your home and there's a significant loss or anything like that, you'll no longer be able to itemize that. And then also there's a small benefit that was previously an adjustment that was previously done for moving expenses. If you had to move 50 miles or more for work, the expenses for that were an adjustment to your AGI. However, going forward, the only exemptions for that are going to be for members in the armed services. And finally, the last big one is that previously you could claim mortgage interest on a home up to $1 million or $500,000 if you're a single filer. Going forward, that's going to actually be reduced to homes homes that were purchased with a value of less than $750,000. The one good thing about that is that the prior mortgage deductions are grandfathered in, so the 750 is only going forward 2018 and beyond.
So in essence, the first thing that we could take away from this is that the higher standard deduction possibly eliminates the need for a itemized deduction, generally speaking. And in the
for the most part, the majority of taxpayers with the new tax plan will most likely not be itemizing unless they have maybe some significant medical expenses, and like you see on this chart, a lot of the SALT limitations are now significant and in play. Mortgage indebtedness on your interest, if you have a large home, less of that could be deducted. So that was generally geared just to make it itemizing it harder. And again, for the most part, it's looking like the majority of people that did previously itemize would probably not under the new tax plan.
Okay. All right. Let's discuss, Crystal, some credits.
So to first start, the first adjusted credit that was in place for the removal of the personal exemption spoken about previously is the child tax credit. So in 2017, if you qualify, you are able to take up to $8,000 in regards to a child tax credit. This is including the possibility of getting the $4,050 personal exemption for qualifying dependents. However, in 2018, this is now changed to $2,000 for the child tax credit, with a possible $500 for other dependents that are considered qualified dependents but aren't specifically a child. This is due to the exclusion of the $4,050 personal exemption that is allowed in 2017 but no longer allowed 2018 going forward. And the chart that was provided to you also shows you what the earned income tax credit has been adjusted to in effects because of the child tax credit.
Okay. So it impacts, people with certainly incomes in this level, essentially.
Yes, and this specific tax credit was actually broadened as in who may qualify for it, since there was a large portion of individuals who couldn't even obtain the child tax credit because the AGI had already dropped to zero, as in taxable income was zero. So you couldn't get a return off of this child tax credit. However, they have made exceptions to this for 2018.
Okay. Let's talk about any additional income adjustments. Any highlights there? Go ahead. Crystal?
So, again, your comparison from 2017 to 2018, the first change that seems to be very well highlighted is that in 2017 you have the minimum essential coverage penalty. This is associated to your health insurance, which is considered to be qualified under minimum essential coverage. In 2017, if you don't have the proper coverage that the government mandates, there is a penalty for it, which is either 2.5% of your household income or $695 per person, whichever is higher. However, in 2018, the minimum essential coverage penalty is not removed. It is, however, reduced to zero. The other major change is AMT.
Quickly, just a quick note here. Again, this just gives you an idea of how much things are changing. Just as an update, our review here shows that the 2018 minimum essential coverage penalty remains. It's actually starting 2019 that penalty is reduced to zero. So you're still required to have health insurance in 2018, but starting 2019, you're not required to have that health insurance. Continue, I'm sorry.
That's correct. So in regards to AMT, this doesn't qualify to a handful of people. However, there is guidelines to it. So AMT is the additional, excuse me. So AMT is at $86,200 for married couples. This is the income level to which AMT starts applying to, above $86,200, and the threshold is $164,100. A phase-out threshold is actually the maximum amount that will be under ruling for AMT. However, in 2018, the exemption amount was up to $109,400. However, the phase-out threshold was increased to $1 million. What this effect does is that your income up to $1 million will be subject to AMT.
Right. So for those, just to simplify, alternative minimum tax is the second tax that every American has to file. So we all file 2 tax returns, not one. We file a regular tax return and an AMT tax return. Whether you see it or not, everyone has to run that. And basically, this is the U.S. version of the flat tax. And what is important to note here is that starting 2018 onwards, although you will have to have a higher income from where you can see that exemption to really be, the AMT to be applied to you. However, more families will likely be coming within the AMT, if you would. As you can see, the phase-out has now been risen all the way to $1 million. So a lot more families will be subject to AMT as they move forward. Okay, we'll take a look at estate and gift tax exclusion at 11.2 million again here shortly. But that was the other change. It doubled from 5.6 million per person to 11.2 million in terms of estate taxes. Right. Mitchell, you want to talk about corporate taxes?
Sure. So this was the original main sticking point that the Trump administration wanted to run through, and basically stating that the 35% current tax rate for corporations is too high and not competitive to the global environment. However, this is a tiered rate, and due to tax credits and other loopholes, generally the average tax rate paid by corporations was more around 18%. So the maximum current rate is 35%. That's been dropped down after negotiation down to 21% in 2018. And like Salim mentioned earlier, the corporate tax rate change is permanent, while the Individual ones are temporary, beginning phased out, and certain provisions beginning in 2022, I believe it is, that begin being phased out. One of the interesting aspects that was changed is currently corporations are subject to a worldwide tax system wherein any profits that are made worldwide are taxed under the U.S. tax system if they are brought back to the U.S. And that's why you might have heard a lot about on the news about certain companies like Apple or others where they have global operations. However, they stash a significant amount of money offshore, thereby not having to pay taxes, U.S. taxes on these amounts, and just having to pay the foreign locale tax rate. So essentially, this is one of the sticking points that's been brought up where companies have no incentive of bringing money back into the U.S. because they'll be taxed at higher U.S. rates. So in order to change that, the corporate tax rate now is based on a territorial system where foreign profits are no longer going to be subject to U.S. tax rates. So that's going forward in 2018. Now, cash that has been stored overseas from before that will be subject to a one-time repatriation tax of 15.5% on cash-type assets and 8% on equipment that's brought into the U.S. So that's a significant change in the way corporations are going to be taxed going forward. Another big item is that equipment generally is subject to MACRS depreciation, which is, for the most part, over time, depending on the type of equipment. It could be 3 years, 5 years, 7 years, etc. However, now equipment, not fixed asset like a building, but equipment will be essentially depreciable in the current year that it is purchased. So that's a significant deduction for tax purposes if you're in a equipment intensive industry. Also, previously, interest expense for corporations was fully deductible, and that's one of the ways a lot of companies do their business. They rely heavily on debt and also on the savings to the bottom line that they get by being able to deduct interest expense fully. However, going forward, interest expense will be subject to basically like an income tax, where you can only deduct up to about 30% of your total income. And the purpose behind this is to discourage excessive debt usage when trying to grow your business. And in theory, I guess they think that by doing this, there will be less of an incentive to rely specifically on debt, perhaps use more equity type solutions that would possibly help lower bankruptcies. The AMT tax for corporations was previously in effect. However, in 2018 and going forward, for corporations, the AMT tax has been repealed. So there is no technical minimum that must be paid now for corporations. So this is another difference between the individual and the corporate structures, where the individuals are still subject to AMT taxes, but the corporations are not. Excuse me. So also previously business losses could be carried back 2 years or forward up to 20. There's been a change now in 2018 that losses cannot be carried back, subject to some limitations, but you can carry them forward. And a professional service corporation also would have a tax rate of 21%. Now, professional service corporations generally include things like doctors' offices, lawyers, accounting practices, and such. And then on the bottom here, we just have that the dividend tax rate for individuals will stay the same depending on the circumstances, which could be from 0 to 20% essentially.
Right. So, this is very important for a lot of our clients and people that have, companies that can be classified both as a small and medium-sized businesses, not only big businesses, to start to think about all the different deductions that are there, and whether at 21% tax rate, does that make sense? Understanding that their dividends can be taxed in addition, this is a major planning area going forward to look at. This, in addition to the pass-through businesses, and pass-through businesses, Mitchell, have now a 20% standard deduction that is given below the line. So this is after an owner, has their taxable income. They can then, go down and look at this particular income. Can you elaborate on that?
Sure. So pass-through businesses are generally the majority of businesses started in the U.S. Corporations are a relatively small portion. However, they have the highest market values due to their ability to grow to massive sizes. But pass-through businesses are generally the small businesses. These are LLCs, limited partnerships, general partnerships, S corporations, and such that allow all the profit or loss to flow through to the owner's individual tax return. So in 2017 and previously, all of that just flowed directly to the owner, generally through K-1 forms that would be issued by partnerships or S corporations and such. Now, going forward in 2018, there's still some guidance that needs to be really clarified in this area, but what's in the rules right now and how it will be implemented is specifically will be open as this continues. But what's essentially in the rules right now state that any amount passed through to the owner, any income passed through, will receive a 20% deduction on that income that flows through to the owner. Now, this was put in place essentially to allow these businesses to get on similar ground that the C corporations are, since their tax rates are being reduced so drastically. This was put in place to essentially try to level the playing field between these pass-through type business structures and C corporations. So generally, on most businesses will receive this 20% standard deduction. Professional service pass-through businesses also will receive these. However, there will be a phase-out beginning at $315,000. So if the individual owner of let's see, like an accounting firm or a doctor's office will basically get more than $315 in taxable income on their tax return, that 20% deduction starts being phased out on their return. Now, this isn't an issue on another type of structure that's not a professional service type organization. So if it's just a normal retail operation, or a type of service that is not professional, like a landscape business or anything like that, then it won't be subject to this rule. But however, any type of structure, whether it's doctors, lawyers, accounting, engineers, or possibly would be lumped into this, then this type of organizations would then be subject to these phase-out rules.
Quickly on 1031 exchanges and 529 plans, for those that are interested in particularly property, in the past you could have exchanged, when you sell a property, you exchange it to avoid capital gains taxes into another property. In the past, you could have, under certain circumstances, replaced a personal property. However, going forward, it can only be replaced by a real property. So if there's any transactions such as that, literally, people have only 3 days to effect that. Another change that is interesting is the 529 plans. These are tax beneficial plans for education purposes, used to only be able to use it for higher education. Going forward, you could use it for private schools and primary education with a limitation of $10,000 per child per year. And again, as mentioned before, estate tax exemption limits have been raised to $11.2 million per person. So a family could see and pass on $22.4 million in assets to their next generation. And this, going forward in the next few years, particularly between now and the expiration of individual taxes, provides for very good opportunities to to see what kind of an estate planning work can be done. So in essence, just to summarize some high-level planning ideas, particularly on the individual sides, we have been talking about what are the things that families could do and pass-throughs could do. And one of the things that jump out really, first thing is to say, are there any tax-eligible expenses in 2017, in 2018 that can be pulled into 2017? So for example, consider paying your real estate taxes that are due January 31st now in 2017. As we saw earlier, as the higher standard deduction makes it more difficult, or at least it creates a higher hurdle rate for charitable donations. If you were going to make any charitable donations in 2018, consider making them now in 2017. For those that are pass-through businesses, you can think about, and other C corporations, for example, if you can think about passing income down to the next year. So if there are opportunities to create income, you can forego that into the next year. Particularly for sole proprietorships that are on cash basis, they can also think about pulling in expenses and paying down expenses now in 2017 instead of 2018. The other area of planning should be a retirement plan, for example, in 2017. So there are opportunities for both pass-through businesses, sole proprietorship, to be able to create a retirement plan now in 2017. And funding can happen in 2018, but we can think about a retirement plan in 2017. The other planning area from a these are all short-term. The longer-term planning area is, as we saw earlier, that the individual tax cut is going to expire at some point in time. Now, there is already sort of speculation that that would be extended, but we don't know that for sure. However, between now and then, there's a timeline for planning, and so it is important that we sit down and have a thorough analysis in a tax review to take a look at what are our sort of short-term, mid-term, long-term tax beneficial and changes that we can make. We talked about estate planning, for example, plan on generational transfer and take advantage of the higher limits now. For corporations, it is important for our business owners, particularly both small and mid-sized business owners, to compare and consider now whether a C corporation would make sense. One of the biggest complaints we hear from our pass-through and business owner clients is, hey, I made this money, but I didn't keep it. I put it back into my business, but I'm still having to pay this taxes on it. Yes, that's because it's passed through to you. If that is a cause for concern, then we should definitely take a look at whether or not a C Corp now makes sense over a longer period of time. As Mitchell mentioned earlier, capital expenditures are a big thing. If you were trying to make that in 2017, make sure that, delay that decision if you haven't made it already for 2017, make it in 2018. And then, of course, cash businesses that we talked about. So it is important for you to understand that these are all high-level ideas and thoughts. We welcome your comments and questions now, but please understand we would love to sit down with you or have a conversation between now and this weekend to see what else we can do. And then, of course, early in the year to schedule 2018 and further on tax planning. Mitchell, Crystal, any other comments on your side?
No, I think we touched on most of the highlights. So, I think let's just open it up for a few questions if anybody has something. But, for any specific information, it'd probably be best just to sit down or have a call as quickly as possible if anybody had a detailed question.
All right. Yeah, so please use your chat or depending upon where you are, if you can speak into the microphone directly and ask a quick question. All right, I'm not seeing anything pop up right away. Mitchell, Crystal, any final thoughts?
Uh, not really. Just like I said, if there's any real specific questions, we can maybe do a call. The only bad thing about, about this was that it was issued just a week ago, so it really gave people very little time to consider some of the ramifications. So basically, a lot of people right now are kind of just scrambling to see how best to handle the situation, whether it's accelerating expenses or income or delaying it. So there's a lot of factors involved, but it would have been nice to have a little more time to see the final rules.
All right, with that, we thank everyone participating on the call. Really appreciate it. Hope this was helpful. We went a little bit over the time, but there's so much to cover. Again, we are available for you. That is our contact information. You have it. Give us a call, send us an email with any specific questions. We are working, through tomorrow, and we'll be available through email on Saturday as well if you have any other questions. If not, Happy New Year to everybody, and may the new year be prosperous for everyone. Thank you very much, and have a great day.